Hey everyone, welcome back to Signal or Noise, Episode 3. Charlie Bilello here, joined with Peter Mallouk. And as always, we're going to try to help you separate the signal from the noise. And Peter, boys, there are a lot of noise today, and it's really centered around one thing, and that's the debt default or coming debt default that's going to cause a stock market crash, a Great Depression, everything else you can imagine. The media is really bombarding us every single day with these fears. Give me your high level view of the debt default. Should people be concerned about this? What do you think will end up happening?
So I think if there was a debt default, I don't think the consequences are overstated. I really do think it would be catastrophic for the markets and the economy and have repercussions we probably can't even imagine. But I think there's the odds of a default are way less than 1%. And that's because it's not in anybody's best interests. I mean, the people that are going to decide whether we default or not are Republicans and Democrats, and both of them lose if there is a default. They also lose if they compromise in advance. And so if you look at, McCarthy and Biden, they're negotiating with each other, and if they reached an agreement today and had to go back to their constituents are going to be furious with them. Hey, you caved in on this and that and the other, and neither of them can throw up their hands and say, "Well, I did all I could." They'll go, "No, you had time left, and you should have fought harder." So it's in both of their best interests to wait till the very last second, where the narrative shifts from "I caved in and compromised" to "I compromised to save the economy and save your jobs." And that's we go through this thing over and over and over again.
Yeah.
And hopefully, it's kind of like mutually assured destruction with nuclear weapons, right? If two major nations have nuclear weapons, you're pretty sure one won't drop a nuclear weapon on the other. There's no guarantees, but it's in everyone's best interest for it not to happen.
Yeah, no doubt about it. It's like the movie Groundhog Day, where we're seeing kind of the same thing over and over again every couple of years. They extend this, and then we have the same debate. I think everyone remembers 2011, and the market, very briefly went down very sharply over these fears, and that's kind of still fresh in our minds for some people. But at the end of the day, I think it was a few days before they ended up coming with up with a resolution. That seems to be probably where we're headed today. The question a lot of people are asking is, well, what exactly are we going to run out of money? And I think we're down to 60 billion left in the general account where they use to pay things like Social Security and Medicare. And I guess, there's different types of default. Like there's the one type of default would be the government is just not paying their interest and principal on treasury bonds or treasury bills. And I don't think there's any way that's going to happen, right? So it's really a question if this did come to the point where they're running out of money, and I don't think it's going to be that scenario, then they would have to prioritize between paying interest and principal, which I think they would do first, because that would just be a serious problem for financial markets, and then have to put off the spending on those other areas until they come up with a resolution. But again, I think all of this will be resolved before the end, because like you said, it doesn't make any sense for either party to take the blame of not extending this in the short run. And really, this is a movie we've seen so many times going back to 1970 is this chart, but you see that debt ceiling, the red line there, gets raised, raised, and raised. For a little while, they suspended the debt ceiling, and they didn't have one. Now it's back again, and I suspect a year from now, we're going to be having the same debate that's going on today. I don't think they're going to push it out a few years. The Republicans will probably want this to be an election issue if they don't get what they want in terms of spending. This is likely to be a year from now us talking about the same thing. And 78 times since 1960. And why does the debt ceiling continue to have to be raised? Well, because the debt level is going up, right? We're spending more money than we're taking in. I love this table of national debt milestones, and especially since the 2020 stimulus efforts, that exploded the national debt, right? We went from 23 trillion to all the way up to 31 trillion. And if we look at debt as a percentage of GDP, it's headed in one direction. Does longer term, so forget about the short term, but to me, this debate is really missing the forest for the trees, right? We're hyper focused on this limit, but we're not talking about really the long-term consequences of continuing to increase national debt. Does this concern you, let's say, for the next 10 years? Forget about the short-term debate that's going on.
I think the increases in the limits in the beginning, decades ago, were not as concerning. I mean, if you have a $200,000 mortgage against a $300,000 house, and then 10 years later you have an $800,000 mortgage against a $1 million house, yeah, you have record debt, but the value of your home is up, and so it makes sense. Just inflation-wise, it makes sense. It's the percent of GDP, which this chart shows, that's extremely concerning. I mean, we're spending so much more money than we have. And there's a mythology that actually gained some ground a few years ago. It's starting to lose some traction now that it didn't matter at all. And it really is like a household having more debt than assets. It's a very big problem that is eventually going to have to be addressed because of what will eventually be an alternative to the dollar that puts lack of confidence in the dollar. And I think the bigger issue here is a lot of the spending is recurring. So regardless of your political, views, a lot of the spending is not like a one-time, we're going to go have a war in Ukraine and go do this one thing, although I would say that's a recurring thing too, us having these perpetual wars. But I think that a lot of the programs that we have that are expanding this debt, they're not going away. They're not one-time spends or 3-year spends. They're recurring and expanding. And so at some point, there's going to have to be a coming together of the parties to figure out, well, how are we going to get this thing whereas a percent of GDP, it's more under control.
Yeah, and I think the big issue with these types of numbers is it's hard for people to understand what they exactly mean, right? And there's no set breaking point, right? We don't know if it's 150% or if Japan is over 200%, right? Most countries, once they get above a certain level, it's usually, I think, historically around 150%. It becomes problematic, right, in some fashion or another. Now, Japan's chosen to deal with that by essentially having their central bank buy all of the government debt every single month. But there's obviously issues and problems with that as well, right? And so I think the most likely scenario, unfortunately, with this chart here is it goes higher until it causes a real crisis, right? And we're having this debate from a position of weakness instead of a position of strength, right? Because, like you said, the biggest parts of the budgets are recurring, right? It's entitlements, Social Security, Medicare. Neither party wants to touch that or deal with it. And with the baby boomers just increasing every single day, and fewer younger workers, that's going to become more and more of an issue. And as we talked about in a prior video, the interest expense alone on this debt, right, which is why it becomes problematic when interest rates rise all of a sudden here, right? We're at over 800 billion just going to interest payments, and that's likely to go over $1 trillion in the next few months. That alone becomes problematic because then you're borrowing money to just pay back the interest. So I think this is something that unfortunately will have to start to cause real pain before people want to give up the benefits that they've become accustomed to, frankly, right? It's like, I don't hear anybody saying currently, let's have a 401k system for Social Security. Let's at least start it with younger workers. Like we've promised these older workers they're going to get what they paid into it, but let's at least going forward resolve the situation where we're making promises that we can't keep, right? I don't know what you think about that, but why shouldn't you have, and some countries do this, have an account that has your name on it and their money is there because it was put there to begin with?
There are all kinds of solutions that I think Americans would be open to. I just think if anyone opens their mouth to present one, they'll be painted as someone who wants to destroy a program that most Americans like. And a good example, Social Security, you've made a promise to several generations. You have to keep the promise. But there's no 37-year-old that thinks that they're going to get Social Security when they're 66 or 67. So how about we be honest with them and say, hey, you know what? Life expectancy when Social Security was set up was 62. Today, life expectancy is in the 80s. If you're under 30, you're not going to get Social Security until you're 72 or something like that, right? There's very small tweaks to the program, make very, very substantive differences, but they're never going to have a conversation about it that's reasonable. until it's a imminent crisis. I mean, like pending, just like we're dealing with this, where they're not going to reach a settlement till a day or two before. They're not going to want to solve it. The way democracies work, when there's only two parties and no middle pulling them together, there's no incentive to compromise unless you can wave your hands in the air and say you saved the bus from going off the cliff. But people have to believe the bus is going off the cliff. You and I and everyone knows the cliff is in front of the bus, and if the bus doesn't change directions, we're going off the cliff. But we also know it's not tomorrow. And the way our system is set up is unless the bus is going off the cliff tomorrow, there's just no political incentive for the parties to reach any kind of compromise.
Yeah, and I guess the hopeful view, and some people have suggested this, is we can just grow our way out of it, right? That if we could just boost GDP instead of 2% a year, which is real GDP over the last 20 years, we can do 4%, 5%. Well, for sure, yes, that if we could wave a magic wand, that would be very helpful. If we could do that. The issue, of course, is that's not so easy to do, to bump up GDP that much. And again, when you have this much debt, it takes away from economic growth historically, right? So hopefully we won't wait to a situation like countries like Greece have had, right? When it gets to the point of no return, that's when they start having to deal with it. And then you have to put in these severe austerity measures. There's simple things you could do. You could mean test Social Security, right? You can increase the percentage withholding. No one's going to like any of these things. But essentially, at some point in the future, we're going to have to figure out how to pay for some of this stuff. But in the short run, the trend is going to be higher, Peter, because tax receipts are now going down. So all of those capital gains that people were making in 2021, well, they weren't there last year. That was a big factor driving this lower. But government spending went up 7% over the last year. So we're less money coming in, more money going out. Result, bigger government deficit. So you cannot have a debt ceiling when you're borrowing more money at a $2 trillion clip, right? So the whole notion is kind of absurd. The debt ceiling will have to be raised. And from a stock market participant, if you're looking at the last 50 years, it was pretty good advice to ignore this whole thing that's going on in the federal government. The stock market's done pretty well, right? Over 10% a year. This whole time debt is going up. Whole time debt to GDP is going up. That's not to say it doesn't matter or won't matter for the economy at a certain point, but corporations have done a pretty good job of managing their own fiscal situation and generating profits, right? Year after year, in spite of all of this. Now, do you like if someone comes to you? So we're getting a lot of questions from clients, from advisors, and they're saying, well, what should I do to my portfolio around this upcoming perhaps default, which we don't think is likely? What's the best thing that you could tell a client in this type of situation?
I say these risks are real, but very, very, very minor. And I think, like, in terms of the probability, and if you start to make portfolio changes based on things that have a probability of happening of, one in, thousands, you're going to cause far more harm than good. And I think the market itself is telling us it's pricing in very close to a 0% chance of a default. We can see this from the bond market and the stock market. It's not behaving as if there's a 1% chance of a default. And so I'd call this all unactionable. I mean, we spent a lot of time covering the probability of this happening and our longer term issues. But certainly for the foreseeable future, I wouldn't be making decisions based on it.
Yeah, so it's a lot of noise, and if you're a long-term investor, actually, the best thing that could happen here, if you're buying in or adding to your 401k or IRA every month, is some short-term panic, right? To get an opportunity to buy in lower, because in any scenario, even if there was a technical default, which we don't think is going to happen, even if there was and the stock market went down 20-30% in a short period of time, well, that would be very quickly resolved because of that, right? So it would actually be a good scenario for long-term investors, assuming they didn't panic. It would create some opportunity. Okay, so I think we covered that. Do not fear the debt default. Don't make any changes to your portfolio. The debt ceiling will be raised just like it always has. So Here's an interesting poll that Gallup put out asking what's the best long-term investment. And I know you know the answer to this, but might surprise some people, but probably not because they're probably thinking this as well. Real estate, number one. That took that was the case for most of the last decade, but really took a turn higher here over the last few years. And what's driving that, Peter? Well, simply recency bias and the fact that home prices have almost doubled nationally. And if we look at the 20 city index, have doubled over the last decade. And your house, if you're like most people, is the biggest component of your net worth. So naturally, you wanted to see it go higher. What do you think about housing as the best long-term investment? Does that make sense to you?
Well, I think definitely more people have a house than own stock. So I think, like to your point, that's a very big part of it. And if you look at the last decade, which is one of the best performing decades ever for residential real estate, basically 6% a year, and that's not counting all the costs you put into it. Now, I have a house. People should have houses and enjoy houses. I'm not being critical of houses, but when we put them in the investment category, they're not a great investment. So the stock market over the last 10 years dramatically outperformed owning a house. And along the way, it gave you dividends. It didn't take, money away from you. So the two really aren't comparable in my mind as a real investment. If you put $1 million and more in your house and you put $1 million in the S&P 500, the odds are overwhelming that over 10 or 20 years, you're going to have several times more money from the stock side of things. But more people have houses. We just had a 10-year run, of which most of it came in the last couple of years. You can see in your graph it's giving some of it back. And I think we're going to see more of that happen as rates continue to rise.
Yeah, it's interesting that people, they say, oh, I bought a house 10 years ago, it was 250,000. Today it's worth 500,000, and that's awesome, right? But they never include the mortgage interest, the taxes they're paying, the homeowner's insurance, all of those additional costs. And if you're in a house for a long period of time, those costs can really add up, right? And they never include that in the calculation. So just be aware of that as a bias. Not to say, like you said, that you shouldn't own a home if it makes sense financially. You should, and just keeping expectations in check. And in terms of those expectations, historically, owning a home has meant kind of keeping pace with inflation, right? Which makes sense because inflation is a reflection of the cost to build a home in part and your wages, right? So really, home prices should go up with those factors. It should be based on affordability, based on people's incomes going up, based on general inflation, right? And we've had two periods now in the last 20 years where we've become kind of divorced from that, and that's lifted expectations about future appreciation. The first period, of course, during the housing bubble here, when everyone was saying home prices never go down, and therefore they're in a new and improved stock market, right? We had just gone through the dot-com bubble where S&P went down over 50%, NASDAQ went down over 80%, and they're looking at their home price just go up every single year, and they were saying things like home prices never go down, and then, of course, 5 straight years, home prices did indeed go down, and now we've had the second, I would argue, second housing bubble higher, and we have those same elevated expectations. Now, I thought this was really an interesting kind of juxtaposition here where you have people saying that housing is the best investment, but they're also saying this is the worst time ever to buy a house. So how do you square those two things?
Yeah, you're in a house and it's gone up a lot in value, so it's the best investment, but you know that's driven a large part by the flood of stimulus and the low interest rates that inflated home values coming out of COVID, and buying a new home today because of that's very, very expensive. And I think everyone knows that this is going to soften. I mean, I just think we're starting to see it a little bit, but it's going to soften more.
Yeah, and the housing affordability index, I think, is a good visualization of this. Just we crossed at below the last housing bubble in terms of affordability, and this is just based on monthly mortgage payment, taxes, and looking at people's incomes and saying it's less affordable than it was even during the last housing bubble. So just to end here with a chart, and some people debate me saying this is nothing like the last housing bubble. And I just show this chart here and just looking at home prices relative to inflation, and we far exceeded the 2006 peak. And historically, again, not that you shouldn't expect it to appreciate, it has over time, but kind of setting expectations is appropriate here. And that expectation really should be around what the inflation rate is, hopefully a little bit higher in the long run. So big tech is getting bigger again, right? Last year, not so much. Now we're going back in the direction that persisted really for the decade before 2022. You got Apple and Microsoft, two biggest companies in the US, now 14% of the index. That dwarfs any two companies going back to 1980. Apple alone, 7.4% of the index, biggest weighting that we've seen for any individual company. And all of a sudden, Apple is now worth more than the entire 2,000 stocks in the Russell 2000 small cap index. Does this surprise you? What do you make of Apple's kind of dominance here in terms of its weighting, and this interesting factoid that Apple, I think I heard it also, it's bigger than all of the UK stock market as well, which was an interesting one.
It's hard to overstate the reality of Apple's dominance and how there's apparently no end in sight to it. It's very different than other big tech companies where you can, years ago you could create a narrative of what might happen to a Netflix or even an Amazon or something over time. But Apple, it's very hard to deconstruct their, what could go wrong, what could happen to Apple. I mean, Apple is basically a major economy in and of itself. When you enter into the Apple ecosystem, you're part of an economy and you're in that ecosystem. It's got a very big moat, very hard to imagine. As Warren Buffett said, can you imagine, giving up your Apple, your iPhone and your Apple products? Most people, it's unimaginable, right? And then what other ecosystem is a legitimate alternative? And every new addition that happens in that ecosystem makes it a stronger ecosystem. And their whole model is also based on recurring revenue. I mean, every component of it is recurring revenue. And so it's not surprising, and actually would not be surprising to see them double from here again. Now, it would take a long time. It's obviously a very, very big company, but it's not hard to create that narrative. You get prices up a little bit, you add a product or two, you penetrate into the billion people coming out of poverty all over the world, and there you are. And so I think we're going to see more and more of this, that Apple's bigger than these 15 countries combined, and Apple's bigger than the bottom several thousand stocks combined. And I think it's going to continue. I just think that it's an incredible story of dominance. Also, not a natural company to break up. It's not going to be an easy thing for politicians to deal with, where they can just divide it into 3 or 4 companies the way they do when with AT&T, for example, starts to dominate one space, or if
they have a better monopoly than IBM, or
right.
I guess Microsoft is still up there, but that's the exception. ExxonMobil. I guess if you go back in time, it's hard to GE, AT&T, right? It's always hard to envision the current leader being knocked off, right? It's just, and it's more so with Apple, like you said, because it's really in everybody's everyday life so much. Who's going to come in and take that? I mean, I think the argument for years is, well, how can they maintain that profit margin? How can they continue to sell this phone at a premium, right? Like free market capitalism, someone should come in, and many did, and try to undercut them, right? And just Apple built that system and created that brand where people would pay up for that value, and then they made it easier integrating it with the other things where people say, it's worth it to pay that higher cost for that ease of use with everything. Now, does someone come along and disrupt that at a certain point? Likely, but very difficult to see Apple, very quickly going down. It's not like a regional bank where where people are just going to leave Apple en masse. So if we look at the fundamentals here, I think this is pretty interesting here. The Apple's net income, its profits, $94 billion over the last year. It's an incredible number. All of the stocks in the Russell 2000, $52 billion. So, so fundamentally, if you're just looking at earnings, it kind of makes sense, right? And I dug into the Russell 2000 number there. 40% of the companies in the Russell 2000 have negative earnings, right? So they're not making anything at all. So that includes that as well. If we're looking at revenues, though, Russell 2000 revenues far higher than Apple. So what's going on here? Apple's trading at a premium price to sales, right, on the expectation that growth is going to be higher than the Russell 2000, and obviously it's trading at a premium on earnings because its profit margin is way higher, and 30 times earnings and over 7 times sales. Not cheap for Apple, right? So that for sure that could go lower, right? And will
I
if
mean,
there's
that's
any question.
nuts for a company that size. I mean, it's just
Yeah, not something you would expect. So just ending here on the relationship between small caps and large caps, and anyone who's been paying attention to markets, this is a, with that exception of that brief interruption in terms of late 2020, early 2021, where small caps just went crazy in an extreme move higher. Um, Large caps have dominated, right, over the last decade, and so a lot of investors who have small caps in their portfolio, some lagging now. You have to go back to 2001, right, to find the relationship small caps underperforming large caps for this period of time. And I think the question for people, why do I own any small caps, or why should I own any? Similar to what we were talking about in the last video with international, right? But of course, there's been cycles in the past, but S&P 500 is about, I think, 80% of total market cap. Is that enough for most people? Is there an argument to be made long term to include these other companies in your portfolio?
well, definitely if you're starting out, you should just put your money in the S&P 500 until you get to $50,000. I think that's pretty diversified, get you some even global exposure because a lot of the earnings are from overseas. I always tell people when you're starting, just do that. But the wealthier people get, the more they diversify. That's just the reality, all the way up from the millionaire next door to billionaires. The more money you have, the more you actually move to smaller companies, mid-sized companies, overseas companies, and so on. Put your eggs in different baskets, bet on the future winnings. All these big companies we're talking about were small companies at one point, and that's when most of their great returns happen. And I think that the large cap, small cap story, it's really a big tech versus everything else story. The S&P 500 without big tech doesn't look as great. It's big tech, what we just talked about, Apple, Microsoft, all these companies, they've really carried the day, and they've skewed the way investors look at everything. Now, at Creative Planning, for example, the biggest position for most of our clients is large cap US. That biggest position for, again, most of our clients is going to be Apple and Microsoft and the companies that make up the bulk of the S&P 500. So the exposure is there, but the ones coming in the future, we don't know which ones those are. That's why people move downstream. They buy the mid cap, small cap. There's a lot of evidence that over the long run, small value stocks do better than large, but you pay a price of long periods of time where that's not the case. So bottom line, starting out S&P 500, you're a bigger account, you're starting to grow. I mean, those smart investors diversifying, obviously.
Yeah, and I guess my argument always is the best time to think about diversifying is when an asset class has underperformed for a long period of time, right? You don't want to think about small cap diversification over here. Better to think about it here, assuming that this is all cyclical and it's going to even out. And I think a lot of studies have shown small caps have a higher risk than large caps, and you're not really compensated for that over really long periods of time. But we've had situations, 2000 to 2010 being a good example, where small caps outperformed by a wide margin. We saw that in the early 1980s as well. So just like U.S. international, it could be helpful in the other direction. It just hasn't been. But that's always the case in markets. You want the diversification after the fact, but you can't have it that way. You have to have it in your portfolio before in order to benefit from it going up. So we'll see. But no doubt this year, right, the large cap tech once again dominating. I think I saw a stat that without like the 7 biggest tech companies, S&P's down this year. It's a pretty crazy statistic. So let's talk about something not related to markets. You tweeted this out, and I saw the video as well. And just Giannis, after losing a series there, he had this interview, and he just had a really interesting comment. I think the reporter asked him, do you view this season as a failure because they didn't win the NBA championship? And his response, I think, was really beautiful for anybody watching it. And in terms of kids and why they should play sports or do other activities or things like that where failure is a frequent occurrence. I think he really summed it up saying there's good days and bad days. There's really no failure here, and it just wasn't their turn this year. You don't always win. What was your reaction to this?
He obviously has a winner's mindset, and I tweeted it out because I thought it was a great message about life, and I also, about investing. I mean, I think like if you ask an investor has a bad year, well, do you feel like a failure? Well, no, because if you're a great investor, you're still going to be down about 1 in 4 years. I mean, you're just going to feel like a failure a lot if that's the case. Very few
That's right.
people walk straight up a mountain with no obstacles and never having to traverse down or anything along the way. It's just part of the journey. And I think if you've got the mindset that every time you're off a little bit, you're a loser or you're a failure, you're just never going to get anywhere. You're going to be a miserable person. I just really loved this video. And I obviously caught a lot of traction across the internet as people found out about it. I think he did a great job.
Yeah, you could tell he had been thinking about it. I think
Yeah.
he referenced that the reporter asked him the same question the year before, and he was waiting to give this response. And
That's right.
we don't see all of the effort and the work right that goes into it, or we just see that finished product where the players, and everyone's focused on the ultimate winner. But obviously, I don't know if you've seen his story. They had a movie about, I think it was called Rise, or a great movie about his family and how the struggles that they went through, and for him to get to where he was. So I think him putting in perspective in terms of all that he's overcome. He's not going to view losing this season as a failure. So if we and this is a great quote that you had. It's really overcoming that failure, and it's in everyday life, right? We're always we see this every single day. There's going to be something that doesn't go your way, and it's really how you overcome that, your resiliency, that really is what matters. And when you're talking to kids about it, that's hugely important because I think there's a tendency these days to try to shield kids from any type of failure, right? We want them to only win, only get the best grades, and that's not reality. That's not helping them because they're going to have situations in life that don't go their way, and learning how to deal with that, I think, is a really important skill. And so, really good message. But I love this tweet as well that you put out in terms of success, that we don't see everything that goes into it, right? And this is really a problem with social media as well, but like we really lionize that end result and none of the other stuff that goes into it do they see. So creative planning, obviously highly successful, $200 billion firm today, all of the hard work and late nights and sacrifices along the way. Nobody sees that. They just see that end result.
Yeah, I mean, I think about this a lot because of social media, and so much of social media is about hacks, like how to get to a certain place without doing certain things. And I find myself, talking to my kids about this all the time, or when someone asks to have a conversation with me that's in the industry, and they're like, "Okay, what are the 3 things I need to do this?"
Yeah.
It's obviously there's more to it. There's more to it than that, and I think social media has given this impression. Because we only see, you only see what someone is the perfect. I saw this image and I just thought that described all of social media. I know you've talked a lot about how, the research around the more you're on social media, the more miserable you become. I mean, there's a lot of studies and research around that. I think it's true because you're seeing a false reality all of the time about the easy way to invest or the easy way to get fit or the easy way to do whatever, and you're only seeing these beautiful, shiny outcomes, but not the reality of what it takes to succeed with anything. I think, as a total tangent, I think this is one of the reasons live sports has become so much more popular. Everything else seems to have declined in popularity, but I think with sports, we see reality. You see the best playing the best. There's winners, there's losers, there's failures, there's successes. You can't hide it, right? It is what it is, and it's one of the few things in our world that you really can't scrub and just throw out a finished product that doesn't show what it took.
It's real, right? Baseball, I tell my son, if you get a hit 3 times out of 10 in the major leagues, you're one of the best hitters in the game.
Yes.
So you're failing 7 out of 10 times, right? And it's there for everyone to see. You're going to strike out all the time, and you just got to keep going, right? So we see those flaws. We don't see it on social media, and it's kind of funny that that's the name, social media, because it's in many ways anti-social, right?
Oh,
You're
100%.
observing things about other people, but you're not really interacting with that. So with that in mind, yeah, we'll we'll try to minimize our social media use today. People often ask me, well, how have you able to stay on Twitter so long? Is it toxic? Is it? Well, the answer is you really can't engage with all of the negativity. Don't look at the comments would be my advice to people, because there's a tendency to have a negative response, I think, rather than no response. If someone likes something, they'll simply hit the like button. If they dislike it, they're gonna let you know it.
Right. My kids ask me all the time, especially when you get just destroyed, by a bunch of people like want to go off on you for some reason. My kids are like, well, doesn't it bother you? And it literally does not at all. You just kind of like look at it and move on, because the
Yeah,
reality is that's just how it is. If people that are happy are going to be much less vocal than people that aren't. That's how it's always been, and that's how it's going to be on social media.
yeah. You're not gonna let an anonymous person or try to ruin your day.
Right.
That would be that wouldn't be a smart way to approach it. Okay, so I want to end as always with signal or noise, and let's start out jobs report every single month. Peter, right? You've been in the business a long time. We got this hyper focus on the jobs report, right? If you turn on CNBC, they'll have a panel of 4 or 5 people all guessing is it going to be over or under, what the market's reaction is going to be, and they'll do that for hours on end that whole morning, and then they'll dissect it for the next week, saying is it good or bad. What's your take
You know,
on
I
the
actually
jobs
this was
report?
the jobs report is one of the few things I think is really relevant and can really be a signal. I think that if you have a lot of people working in good jobs, if almost everybody that wants to work is getting a good job, it is hard. It is hard to paint a negative future. It just is. And so I mean, I don't, obviously there's a huge amount of variability that goes into the economy and markets, many of the things we covered today. But all of those eventually get reflected in jobs. And so
Yeah,
I consider this to be a signal.
yeah, signal for sure for the economy. If we're talking about jobs, so we've had 2 years worth of jobs growth. We have unemployment rate lowest level since 1969. Awesome news. It's great to see. Hopefully that continues. And I guess the question would be for a stock market
Oh,
investor,
yeah.
should anyone
Noise, noise, stock market
100%
noise.
noise, right?
Right.
And this is a chart that really illustrates not only noise but kind of the opposite of what you might expect, right?
Hmm.
We've seen the highest unemployment rate have the highest future returns, lowest unemployment rate where we are today, lower future returns. Obviously, still positive, so not necessarily a sell signal, but interesting to see that. And people often ask me, well, why is this the case? Why wouldn't it be good news that unemployment rate's low and bad news unemployment rate is high? Well, the stock market's obviously forward looking, and the stock market is a reflection of sentiment at the end of the day. And when the unemployment rate's really high, sentiment tends to be pretty bad, and stocks tend to be cheaper. And what happens to future market returns after stocks are cheaper? Well, they tend to be better, as we'll talk about in this last chart here. Equity valuations. You get a lot of different views on this, and there's many different ways to measure, right, valuations. This is a CAPE ratio, which is just simply smoothing earnings over 10 years. But there's always an argument, are stocks overvalued, undervalued? There's a lot of temptation to do something with that as an investor, right? If stocks are overvalued, well, that in my head says that's bad time to be invested. Perhaps I should get out of the market and wait until they're undervalued. How do you think about equity valuations and the chatter about this overvalued, undervalued? Is there any signal in terms of valuations?
I definitely noise in terms of predictability, and the reason is markets can legitimately be undervalued or overvalued. The issue is how long they can stay there, and that doesn't mean they're correlated to short-term, future prices. And so, a lot of people believe in regression to the mean. I do too. If you take the bond markets, I think it's easier to understand. If interest rates are 12, we expect at some point they'll come down, and if they're at 1, we expect that sometime they'll go up. But
Yeah.
as we've seen, in the last 20 years or in the 70s, they can stay high longer than you can handle it, and they can stay low longer than you expect it. So trying to time that is a fool's game.
Yeah, and you can see that in the chart here, looking at the historical average, and then with the exception of that brief period in 08, 09, we've been above that historical average. So just being above the average, definitely not a signal. I guess you could argue that when you're at extremes, like we were in 2000, perhaps that should be an indication that you're more likely to see that mean reversion, but it won't tell you when, right? Because all the way up here, you're thinking there's going to be mean reversion, there's going to be mean reversion, and it doesn't come. And I think this is an important point in terms of bear markets, because we often think that when there's a bear market, there's bad news and stocks are going down. Well, that's the time we're going to get that mean reversion back to that average. And if we look at historical bear markets, they've ended at all different types of valuation ratios, everything from single digits, double digits, and then if you look at, even after the .com bubble broke, you bottomed at a CAPE ratio of 22, right? So even after that huge decline, you weren't at, let's say, an average level of valuation, and we don't know if this bear market is over yet, and so this is kind of incomplete here. But last October, CAPE ratio went down to 27. What is that telling you in the short term? Absolutely nothing, right? And so I think the best we can say is in the short run, valuations can expand, they can contract. Nobody can predict that with any ability, any type of consistency. In the long run, the best you can say is that when you have this extremely high valuation, so highest decile valuations, you tend to see below average returns. And that should make sense because there is mean reversion in markets. Trees don't grow to the sky. Eventually, you're likely to see some type of valuation decline, but it could take 10 years. And if earnings grow like 6% over that period of time, it matters, right? That's going to help returns. You have dividends on top of that. And then you have to predict where that ending valuation is going to be. So are valuations above average today? No question, right? But 10 years from now, where is this CAPE ratio going to be? I have no idea. Right? If it's at the same level, then it's just your earnings and your dividends, right, that are determining a return. If it's lower, perhaps it's going to be below average or above average. We don't know. And I think the best answer, so people often talk about, when they talk about valuations, they bring up Japan. And I think Japan had a CAPE ratio. So we're at 28 for the U.S. market. And we were as high as, over 40 in the .com bubble. I think Japan was double that. You're talking about 80 times at its peak, right? And so the question people always ask is, well, shouldn't someone do something about that? And yeah, no question, they should. But the answer in 1989, if you saw Japan being in a bubble, the answer was very much not don't invest. It was diversify and get into areas that are not in a bubble, right? The U.S. equity market did pretty well, if you remember, in the 1990s, right? And so if we look at valuations today and you're worried about U.S. equity valuations, then the answer is not to not invest for the next year. The answer is to diversify internationally, because we just don't know. International valuations seem to be more reasonably priced if we're comparing that to history. And so perhaps that'll be beneficial, perhaps it won't. So
yeah, I mean, like 2000 to 2010, international did dramatically better than the U.S. The U.S. earned zero. But the last 13 years, international has been a better value, better PE ratio, higher dividend yield, a lot more value by almost every measure, and still underperformed large U.S. Again, I think it's the big tech growth story, but none which happens to be U.S. Based. But the bottom line is avoid home bias, right? Be diversified around the globe to some extent.
Yeah, we just can't predict the future, so the best protection against that is to have something, a little bit something everywhere. And if you're worried about a bubble, the answer is not sell everything. It's to be more diversified. All right, Peter, we covered a lot of ground there. I want to thank everyone again for joining us. If you like the content, as always, subscribe to the channel for more content like this, and we'll see you next time on Signal or Noise.